kind of like, when the news just keeps like throwing stuff at you, economic this, market that, and global whatever. It's a lot to keep up with, right?
Yeah, totally. It's like information overload.
Exactly. So this week, we're taking a bit of a different approach. We're going to really zero in on the major stuff, the big headlines, and try to give you a sense of what it all means without getting, totally lost in the weeds. We're going for clarity over quantity.
Yeah, a curated news feed, if you will.
Exactly. It's like a deep dive into the most important global economic and market shifts of the past week.
Yeah, and I guess you could say we're taking a pretty news-centric approach this time.
Right. News style. So what does that mean? Well, we're focusing on those headlines that really matter.
Like the ones that make you go, wait, what?
Exactly. So where do we even begin? Well, first up, we got to talk about those trade tensions. They seem to be back with a vengeance, don't they?
Oh, yeah. They're definitely front-page news again, especially with the U.S., throwing some pretty big policy changes into the mix.
Right, the U.S. That was a pretty big announcement, wasn't it? 25% tariffs on imports from Mexico and Canada.
Yeah, and not to mention the 10% on Canadian energy.
Yikes. That's definitely a headline grabber. And it immediately created all this uncertainty for global trade.
Businesses especially kind of freak out when trade gets unpredictable. Supply chains get messed up, investment plans go out the window. It's a whole thing.
It's like a domino effect, right?
Pretty much.
And to be fair, lots of news outlets were saying that the actual implementation is on hold until April 2nd, so they can negotiate more. But, the uncertainty is still there.
Yeah, the threat is real. And then there's the whole China situation. They doubled tariffs on a bunch of Chinese products, up to 20% now.
Ouch. And that's just adding fuel to the fire, isn't it? I mean, this US-China trade war has been going on for a while, but this feels like a serious escalation.
Definitely a major plot twist in that ongoing saga.
So what happened when those tariff announcements hit the news? Well, the markets reacted pretty dramatically.
Oh, yeah. Wall Street had a rough week, to say the least. The NASDAQ even dipped into correction territory, which, as any financial news junkie knows, is a pretty big deal.
Right. It basically means a 10% drop from recent highs. Not exactly a feel-good headline.
Nope. And this volatility, spread to Europe and Asia, too, which just shows you how connected everything is, globally.
Right. It's a chain reaction.
Yeah.
One big market sneeze, and everyone catches a cold. But it wasn't just the U.S. making headlines, right? Canada and Mexico, they didn't just sit back and take it.
Not a chance. They announced their own retaliatory measures almost immediately. Tit for tat, as they say.
Exactly. It's almost like an automatic response these days. You hit me, I hit you back. And then, of course, there's China. They weren't too happy about these tariffs either. They slapped their own tariff on some key U.S. goods, and they even issued a warning about a prolonged trade war. That's not exactly what anyone wants to hear, is it?
Definitely not. And it really brings this idea of political risk to the forefront. Suddenly, it's not just about economic data. It's about, political decisions having huge financial consequences.
Yeah. It's a good reminder that politics and economics, they're kind of intertwined. And speaking of consequences, one of the big worries with these tariffs is, inflation.
Right. Especially in the U.S. Because if those imported goods from Mexico and China are suddenly more expensive, well, guess who ends up paying more?
The consumer. And this is where the Federal Reserve comes into the picture, because they got to figure out how to deal with this potential inflationary pressure. So what's the Fed's take on all this?
Well, from what we've seen in the news, they're kind of playing it cautiously right now.
Yeah, the latest jobs report, which everyone was watching super closely, gave a bit of a mixed signal.
It was kind of all over the place, right? Job creation was lower than expected, and the January numbers were actually revised downwards. Plus, unemployment ticked up a bit, and more people were working part-time for, economic reasons.
It's on the one hand, things aren't looking great. But then there's this other thing.
Wages.
Yeah, wages kept going up. And the year-on-year growth is actually pretty strong, which suggests that even if job creation slows down, inflation might stick around.
The Fed's kind of stuck between a rock and a hard place.
But what's Jerome Powell, the Fed chair, saying about all this?
Well, from his statements, which have been, all over the news, it seems like he's in no rush to make any big moves.
Yeah, he's definitely stressing the need for more data and more clarity on what those trade policies are actually going to do. And he's made it pretty clear that they're not going to just blindly follow a preset plan. It's more of a wait and see approach.
But here's the thing. The markets, they're kind of thinking differently. They're already pricing in up to 3 interest rate cuts this year.
So that's a pretty big difference of opinion, right? The Fed's saying, hold on, let's see what happens. And the market's rate cuts are coming. And this, of course, can create even more volatility.
Definitely. Everyone's kind of second-guessing each other. So looking ahead, the next big thing to watch for in the U.S. is that upcoming inflation data, specifically the CPI, the Consumer Price Index. That's going to tell us whether these trade tensions are actually pushing prices up for everyday folks.
Yeah, that CPI number could really shake things up. It could influence the Fed. It could spook the markets. It's definitely one to keep an eye on. But now, let's shift gears and head over to Europe. They've got their own monetary policy situation going on over there, and it's been making headlines too.
Absolutely. So while the U.S. is kind of in this holding pattern, the European Central Bank, or ECB, they actually took action and cut interest rates. 25 basis points, bringing their deposit rate down to 2.5%. And this was actually their sixth cut since those highs back in 2024. So they're definitely sending a signal here.
Yeah, but there's a catch, right? It wasn't just a simple rate cut and done. What was that key detail that all the news outlets were focusing on?
Well, the big thing is they didn't commit to any future cuts. They're basically saying, look, we're going to play it by ear and see how things go. Data-driven, you know?
Yeah, that's a pretty big shift from just announcing a whole series of cuts.
Yeah.
So what's the ECB's assessment of the overall economic picture in the Eurozone right now?
Well, they definitely changed their tone a bit, which is something the financial press picked up on right away. Remember how they used to say that monetary policy was restrictive?
Yeah.
Well, they dropped that language. Now they're saying it's considerably less restrictive, which, hints at a slight change in direction.
Yeah.
And Christine Lagarde, the ECB president, she kept stressing in all those press conferences how unpredictable things are. Geopolitical uncertainty, economic uncertainty, it's like a fog out there. And their updated macroeconomic projections, those forecasts they put out, they reflect that cautious mood. Slower economic growth, weaker investment, and exports not doing so hot either.
Not exactly a rosy picture.
Not exactly. And inflation, they're saying it'll moderate, but more slowly than they thought before, partly because energy prices are so volatile.
Makes sense. It's hard to predict anything when energy prices are all over the map. But one thing to keep in mind, and some news analysts pointed this out, is that these ECB projections don't include those new fiscal stimulus measures that Germany and the EU are rolling out. Those could really boost things down the line.
Yeah, that's a potential wild card. But despite all the caution, the ECB did say they're kind of optimistic about the labor market and how financial conditions are easing up a bit. They're hoping that'll help domestic demand bounce back.
So there's a bit of a silver lining there.
There is. But they also acknowledge those trade and geopolitical risks we talked about earlier, the same stuff that's causing headaches for the U.S. It's a global problem. And on inflation, they said that wages are moderating like they hoped, which is good news. But they also threw in this warning about the euro potentially weakening, especially if that trade war with China keeps escalating.
Because a weaker euro means imported goods get more expensive, which fuels inflation. It's like a vicious cycle.
Yeah.
So what was the market's verdict on the ECB's rate cut and all those statements they made?
Well, it was a bit mixed, actually. European sovereign debt rates, they went up slightly, which maybe means the market was hoping for a bit more of a dovish stance. More cuts.
Like they were expecting a stronger signal that the ECB was ready to really ease things up.
Maybe. But the euro itself actually got stronger against the dollar. It climbed above 1.08, which is kind of surprising after a rate cut. But stock markets in Europe, they seem to take it as a good sign. Like, hey, at least they're doing something to help the economy.
Makes sense. And those market expectations for more rate cuts this year, they've actually been dialed back a bit. It's now down to around 2 more cuts, which was all over the financial news. And Lagarde, in her press conference, she really tried to calm everyone down, saying the ECB isn't going to rush into anything. They're going to keep a close eye on things. She even said she's not worried about those recent jumps in German debt yields. Like, it's all under control.
A calming presence in the midst of the storm.
Exactly. All right, let's hop over to Asia now. Some interesting stuff happening there, too.
Oh, yeah. So Japan's finance minister, Katsunobu Kato, he came out swinging and flat out denied those accusations from Trump about Japan manipulating the yen. That made headlines everywhere, not just in Japan. And it's stirred up this whole trade tension thing again because Trump's basically threatening to hit Japan with tariffs if they don't play ball.
Yeah, it's a classic case of, even when countries are close allies, trade can get messy really fast. And the finance minister was pretty clear that, yes, Japan has been intervening in currency markets, but not to deliberately weaken the yen. It's been to try and control those crazy swings we've been seeing, to stabilize things, not to gain some unfair trade advantage.
It's a subtle but important difference.
Totally, and Japan's really got to make sure the U.S. gets that.
Yeah.
But meanwhile, in a different corner of Asia, China's been busy strengthening its ties with Latin America and the Caribbean.
Yeah, Foreign Minister Wang Yi was all over the news saying that it's a relationship built on equality and mutual benefit. No hidden agendas here, folks.
Right, no strings attached. And, if you look at the trade data, it's pretty clear that this China-Latin America connection is growing fast. China's now Latin America's second biggest trading partner, and the total trade between them is, mind-boggling.
Over $500 billion, and what's really interesting is that it's not just about China sending stuff to Latin America. Latin American imports into China have been skyrocketing, like almost a 50% jump since 2019.
Wow. That's a huge increase. So what's driving that?
Well, a lot of it's about those Chinese consumers. Their appetite for stuff is growing, and they're increasingly looking to Latin America for everything from food and drinks to flowers.
Yeah, I read about Chilean cherries flying off the shelves in China during the new year, and Ecuadorian shrimp's apparently a big hit on those Chinese e-commerce sites. And of course, Brazilian coffee.
It's like a Latin American buffet for Chinese consumers.
Exactly. And China's actually been pushing this whole domestic consumption thing as a strategy. Retail sales are up. Imports of things like fruit and wine are way up. It's like they're saying, hey, let's buy more stuff.
Which creates a huge opportunity for Latin American producers. And these trade deals they're making are helping too. Like that new China-Ecuador free trade agreement, or that first shipment of Ecuadorian canned tuna that went to that special economic zone in Xiongyan. It's all about making trade easier and cheaper.
It's like they're greasing the wheels of commerce.
Totally. And we're even seeing more Latin American companies setting up shop in China. Chilean dairy producers, Peruvian researchers are all realizing that, hey, there's a massive market here.
It's a whole new world of trade, and it's definitely something to watch. But for now, let's zoom back in on Latin America itself and see what's been happening in some of the individual countries.
All right, let's start with Mexico. They're in the middle of some pretty intense talks with the U.S. right now, trying to dodge those big tariffs on their steel and aluminum exports.
Yeah, that's a big deal for them. And their economy minister, Ebrard, he's been making the case that the U.S. actually has a trade surplus with Mexico when it comes to steel and aluminum, which kind of undermines the whole argument for tariffs.
Totally. Like, who's really flooding the market here?
Right. And they did manage to get an extension until April 2nd to keep talking, which is a good sign. Apparently, Sheinbaum and Trump had a chat and agreed to, give it a bit more time.
So there's still hope that they can work something out. And there's also this possibility that, Mexican exports that follow the rules of that USMCA trade agreement, they might get a pass on the tariffs. And that covers a big chunk of their trade. So that could really ease things up.
Yeah, some news reports were saying that 85% to 90% of their trade could keep going under the USMCA terms, which would be a big win. But, and there's always a but, the U.S. is kind of tying all this trade stuff to other issues, like immigration and, stopping the flow of fentanyl.
It's never straightforward, is it?
Never. Okay, let's head south to Brazil. Things seem to be looking up there. They're coming off a strong year economically, 3.4% growth in 2024. And President Lula is even saying that 2025 will be a year of, solidifying that progress.
Yeah, they're feeling pretty good about themselves. And those numbers on GDP per capita and average income, those are definitely trending upwards.
Yeah, and their economy's firing on most cylinders. Industry's good, services are good.
Yeah.
The only weak spot was agriculture, but that was mostly because of bad weather.
Right, nothing they could really control there.
And the projections for 2025 are pretty solid too. They're expecting more growth, and they're focusing on keeping inflation in check, boosting consumer spending, and investing in, infrastructure and renewable energy.
Sounds like a solid plan.
All right, last stop on our Latin American tour is Colombia. And, well, the inflation situation there is still a bit tricky. It's come down from last year, but it's still stuck above 5% for the fourth month in a row. And that's making everyone nervous.
Yeah, 5.28% for February. It's the lowest for a February in a while, so it's moving in the right direction. But it's still above the central bank's target, which is why it's a big deal in the news. And the monthly inflation rate actually went up compared to last February, mostly because of stuff like education, transportation, and public services getting more expensive.
So the cost of living is still a pain point.
Definitely. And then there's the public investment situation. It's actually gone down in the first couple of months of the year. And there's all this worry about the costs of that new health reform they just passed.
Yeah, ANDI, that's the Colombian Business Association. They're saying the cost projections are way off, which could be a big problem for the government's finances.
Yeah, not good news. And then Fitch Ratings, they downgraded Colombia's credit outlook to negative. That's never a good sign. And, their reasons were all about those fiscal concerns, the debt's getting bigger. It's just not looking great from a financial stability point of view.
Oof, that's a tough one. But there is some good news from Colombia. Their coffee production's booming, like best in almost 30 years. And exports are way up, too.
So at least their coffee's giving them something to smile about. But okay, let's switch gears now and talk about the markets. It was a roller coaster ride this week, with lots of ups and downs across the board.
Yeah, and it all started with those headlines about Trump and his executive order on a strategic Bitcoin reserve, plus those tariffs he wants to slack on the EU. That really spooked investors, especially in Europe. Their stock markets took a hit.
Yeah, all that uncertainty just makes people nervous. And the U.S. markets weren't exactly partying either. The S&P 500, the Dow Jones, the Nasdaq, they all had a rough week.
But surprisingly, Colombia's key all-cap index, it actually went up a bit. And it seems like Ecopetrol was the star of the show there.
Yeah, their stock jumped 3%, even though they just reported a drop in profits for last year. But it seems like investors were more focused on the fact that their production's at a 9-year high.
So they're producing a lot of oil, which is good for business, even if profits are down a bit.
Exactly. But on the flip side, Grupo Sura, their stock took a tumble, which probably reflects those broader market anxieties we talked about.
Yeah, when the market's in a jittery mood, some stocks just get caught in the crossfire. Now, the U.S. markets did manage to claw back some of their losses on the last day of the week, but it was still their worst week in months. And those European markets, well, they just couldn't shake off that trade tension vibe, plus the whole ECB rate cut thing added to the mix.
And then there were some individual stock stories that really grabbed headlines. Tesla had a rough week, down 11%. A lot of that's due to those ongoing protests they're dealing with, plus their sales in Europe, especially in Germany, they took a nosedive.
Yeah, their sales in Germany were down 76%. That's a big ouch.
Definitely. And then there are those concerns about, Elon Musk and his political views. Some people think that's hurting the brand.
It's like when the CEO becomes the news, it can really affect the company.
Totally. And then there's Nvidia. Their stock also dropped, even though they're still growing like crazy. But investors are worried about new trade restrictions with China, investigations in Singapore, and even some rumors about reduced orders for their fancy CoWoS chips.
Yeah, those CoWoS chips are the brains of a lot of high-powered computers, so if demand for those starts slowing down, it could be a bad sign.
Right. It's a reminder that even those big tech giants aren't immune to, global headwinds.
All right, let's move on to the less glamorous but equally important world of fixed income, shall we? In Colombia, the TES market, which is their government bonds, well, it was a bit of a mixed bag. Long-term bonds lost value, but midterm ones did okay.
Yeah, and the UVR market, which is linked to inflation, that was mostly down, probably because people are still worried about prices going up.
Makes sense.
And over in the U.S., Treasury yields actually went up. That's because, all this economic uncertainty is making investors nervous.
Yeah, when things are uncertain, people tend to flock to, safer investments, and that can push yields up.
Right. And there's also a lot of talk about companies issuing a bunch of new bonds, which could also affect yields.
Okay, and lastly, currencies. Buckle up because things got pretty wild there. The big story was the US dollar. It had a terrible week, its worst in over a year. It dropped against pretty much every major currency out there.
Yeah, it was a dollar bloodbath. And it seems like it was a perfect storm of bad news that hit the greenback. Trade uncertainty, that weak jobs report we talked about, plus those expectations of more rate cuts from the Fed. And then you've got Europe and China. They're actually opening up their wallets and spending more, which makes their currencies more attractive.
So the dollar's kind of out of favor right now. And the euro, well, that was the big winner. It had its best week in 16 years. It surged against the dollar thanks to that optimism around Germany's new policies and the ECB cutting rates.
And it wasn't just the euro. Most other major currencies, the British pound, the Swiss franc, the Japanese yen, they all went up against the dollar. And even the emerging market currencies like the Chilean peso, the Brazilian real, the Mexican peso, they all joined the party.
It was a global dollar dumping.
Yeah.
And even the Colombian peso, it managed to hold its own. It actually went up a bit, even with that negative outlook from Fitch. That's a sign of resilience, wouldn't you say?
Definitely. Okay, last but not least, commodities. Oil prices had a rough week, biggest drop since October of last year. And that's mostly because of, that uncertainty about U.S. trade policy and the fact that OPEC Plus decided to pump more oil.
Yeah, more supply usually means lower prices. And then we had precious metals, gold and silver. They were shining bright this week, hitting weekly highs. That's kind of typical when markets are freaking out and the dollar's weak. Investors run to, like, safe haven assets.
Makes sense.
Yeah.
And the copper, it also had a good week, which is partly due to all the investment going into mining and the fact that it's so important for, all that green energy stuff.
Right? Copper is like the backbone of a lot of renewable energy technologies.
Huh.
So there you have it, folks. A whirlwind tour of the global economy and markets. What were the big takeaways this week? Well, trade tensions are back in the spotlight, and the U.S. is definitely stirring the pot. Monetary policy, both in the U.S. and Europe, is in a cautious mode, although the ECB did take that step of cutting rates. China's continuing to make big moves in Latin America, and the economic picture in Latin America itself is, well, mixed.
And the markets, they're as volatile as ever.
Exactly. It's a wild world out there, folks. And the thing to remember is that, all this stuff is connected. Trade policies affect inflation. Inflation affects central banks. Global events shake up regional economies. And market sentiment, well, that can change on a dime.
It's a tangled web we weave.
So, as we wrap up, here's a little something to ponder. Given all this craziness, all these interconnected events, what news story or trend do you think is going to have the biggest impact on the global economy in the coming months? And what might be some of the unexpected consequences that could come out of it?
Yeah.
It's something to think about, maybe do some digging on your own.
Food for thought.
Exactly. Thanks for joining us for this deep dive. We'll catch you next time.